gone 95 days now without a really significant 1.5% correction in the S&P, and there's just basically no volatility, right? So there's no real concern here in terms of taking on risk. Here's what you need to know before the bell this morning. Option traders continue to really just pile into these very short-dated options, this what we call Zero-DTE. These are these 0 days to expiration options, and pretty much just gambling in terms of the market in general. And this isn't surprising. There is, and as I said, we've gone 95 days now without a really significant 1.5% correction in the S&P, and there's just basically no volatility, right? So there's no real concern here in terms of taking on risk. So as consumers, as investors continue to take on more and more risk using these very short-dated options, there doesn't seem to be a lot of risk. Again, you're not getting a big move in one direction or the other, so the risk of failure becomes a little bit more compressed here. But again, we're not seeing any real reflection of that either in the volatility index itself or actually in the market. The market just kind of drifting here over the last, even despite the fact that we did have this kind of 5% correction in the beginning of August, which did lead to a small uptick in volatility, that now has seemingly just calmed back down. And even during that correction, it was a very mild correction. The sell-off was very mild. Again, we didn't have any 1.5% or 2% down days in the market. It was just kind of a slow, orderly grind lower, working off some of that previously overbought condition. And volatility remains here at very low levels. In fact, we haven't seen levels this low on volatility since we get back to really September of last year, almost a year ago. And of course, then we got into a bit of volatility spikes, picking up around the banking crisis earlier this year. But again, really nothing here to suggest that the market is on the brink of anything. But again, ultra low volatility is important here, because ultra low volatility eventually leads to higher volatility. And this is just if we take a long-term look at the volatility index itself, we can see that there are periods where you get big spikes in volatility. And those previous big spikes in volatility, of course, are where something ultimately broke in the markets, and always come from very low levels of volatility. So as we always say here, low levels of volatility will eventually beget high levels of volatility. So it is typically a warning sign. Yes, right now everything is fine in the markets. You're able to take on risk without a whole lot of worry. But again, that in and of itself, from a contrarian point of view, is a reason to worry here a bit, because again, very low levels of volatility will eventually revert to higher levels of volatility that will equate to a sell-off in the markets, likely more than what we just saw in the month of August. So at least be aware of that. Young investors that are taking on a lot of risk here with these 0 days expiration options, will ultimately resolve into losing a lot of money, because this is what typically happens when you get this reversal in volatility. That's where a lot of money gets lost very quickly, because again, most of these options that are being bought are on the bullish side of the ledger. They're buying call options on the bet of a price movement over the next 24 hours in a positive direction. So again, if you're on the wrong side of that trade when something breaks, you typically lose a lot of money very quickly. And we see this happen repeatedly in past. But again, just keeping a watch on volatility here is something to pay really close attention to, because again, once you have very compressed levels of volatility, that is kind of your key warning sign for a period of higher volatility levels and market declines. So again, just kind of keep a watch on that. That's what you need to know before the bell this morning.